Hi, good evening, everyone. My name is Simon. I'm from MYTHEO. Today is the 7th of July. It's the 7th of 7. So welcome to our regular MYTHEO monthly performance review webinar. First of all, thank you for joining us tonight. Before we start, a quick introduction of MYTHEO. So we started in 2019 and we basically is an approved digital investment platform by the Securities Commission of Malaysia. And MYTHEO is actually an extension of THEO, the first, the biggest, and the leading digital investment manager in Japan. At MYTHEO, we leverage on technology to provide you with an affordable and yet the most diversified portfolio in town that is personalized to your investment appetite. Our proven investment algorithm help you to build, manage, and maintain your investment portfolio so you can focus on the most important things in life. Our aim is to help you achieve your financial goals and enable your moments in life. Today, you'll be hearing from our Chief Investment Officer, Matthew Stuart-Box. We will be reviewing the performance of MYTHEO portfolio for last month and to understand what's the driver behind them. Meanwhile, we will also discuss on the portfolio optimization that has taken place this month as we try to deliver high quality and low risk adjusted, a high quality risk adjusted return to our investors. If you would like to ask Matthew any question, you can interact with us via the Q&A button on the menu bar at the bottom of the window in which this presentation is displayed. So without further ado, over to you, Matt.
Great. Thank you very much, Simon. Let me just share my screen. Okay. So good evening, everyone. As Simon said, I'll be reviewing our performance for June this year. So we'll go through each of the different portfolios, how they've performed, what's been driving their performance. We'll also touch on some of the rebalancing that we've done to, in particular, the income portfolio this month. And then I'm happy to take any questions in terms of where we stand right now, what the outlook might be for the rest of the year. So this page covers the performance for June and for year to date. And as you can see, I'm sure everyone knows, June was a very tough month for almost all asset classes, to be honest. Global equities were down nearly 8% for the month. Bond markets also suffered, led by the US. Obviously, with the US Federal Reserve raising interest rates by 75 basis points, so 0.75%, which is more than I think than a lot of people expected. So US Treasury bonds, their yields rose and so their price fell during the month, but also a range of other bonds as well. High yield bonds, corporate bonds also suffered during June. On top of that, commodities markets, real asset markets, they also had a tough time in June. And that was really across the board. You can see on here, industrial metals, things like copper were down, energy was down, natural gas, oil were down, food commodities as well, wheat was down, even things like gold, which is tends to be a relatively safe haven kind of asset, was down slightly on the month. So you can see overall this month was broadly a risk-off month. And so a tough time for pretty much any asset class. So what we'll do is we'll go through each of these portfolios in turn and see what were some of the specific drivers behind these. So if we start with the growth portfolio. So just to remind you, the aim of the growth portfolio, its goal is to achieve a high return in the long term at a similar level to the growth of the global equity market. The global equity market was down nearly 8% in June. We did slightly better than that. We were down 7.38%, but still down in June. This is what the portfolio looks like if you look at the different ETFs in the portfolio. So each of the blocks on the pie chart is an ETF representing a specific market in which we invest. And so you can see it's a well-diversified portfolio. The largest portfolio parts that we have are naturally parts of the US. The US is the largest equity market in the world. So we have 20% in US large cap growth, 20% in US large cap value. And then we have investments in a range of different markets around the world. In terms of what was driving performance last month, given the rise in interest rates in the US and the concerns perhaps people have over a potential recession in the US, US was the biggest negative detractor during the month. Both large cap growth, large cap value were down on the month, and they were the biggest drivers of the portfolio performance. Most other markets also were negative in June. The exceptions were China and Hong Kong. They were slightly positive on the month. You can see down here, XI, the China large cap was up 6.4%. We have an allocation of about 3% to China and about 5% to Hong Kong. So they're not large allocations, but certainly in June, they helped us. So that's the growth portfolio. If we move on to the income portfolio. So here the goal is slightly different. The goal is to earn a regular, high and particularly stable level of income with lower volatility in the market. This month, the income portfolio was down 2.55%. And if we look at the components of the portfolio, you can see here again, each individual block here is an ETF. And as you can see, the largest kind of blocks are investment grade, mortgage-backed securities, various investment grade corporate bonds, US treasuries. We also have high yield bonds in there. So quite a wide range of different bonds in there. Global bonds, US bonds as well. During June, the biggest detractors were on this high yield part of the portfolio, with rising interest rates, in particular in the US, and the same kind of concerns in terms of potential slowdown, potential recession in the US that were driving the equity side. They also hit high yield. So we had detraction from high yield and things like short-term high yield, 10% allocation down here. The US Treasury position did not actually impact us so much during June. Our position is smaller than it's been in the past in US Treasuries. We do have some longer duration ones, over 20 years. We also have a lot of exposure into shorter duration US Treasuries as well. So these were not a large driver of the performance in June. Simon mentioned that we had a rebalance or a reallocation within the income portfolio. So I'll explain a little bit about what was involved in that. Just to remind everybody, this is a regular occurrence in all of our portfolios. We do a regular rebalance for most of them once every 3 months. And in that, we take into account the most recent market movements and update the data in our algorithms, reconstruct our portfolios. And in June, the portfolio that was rebalanced was the income portfolio. It didn't lead to a large change in the portfolio, but we did make a few changes driven by the algorithm. So we can see here one ETF in which we increased the weight, one ETF on this side which we decreased the weight, and one ETF where we took the position down to 0. So you can see the ETF in which we increased the weight is this iShares 3 to 7 year Treasury bond. So this is a US Treasuries, so extremely low risk, but also relatively short duration, just 3 to 7 years. And so in a rising interest rate environment, these kind of bonds are some of the ones that have the least impact from rising interest rates or recession fears. In terms of the positions that we decreased, over here we have this one, iShares MBS. So these are mortgage-backed securities. So these are bonds which are backed by, in particular, US residential and commercial mortgages. We decreased the weight on those. And then in the middle here, this is a position that we took down to 0, international treasury bonds. And I think perhaps what's been driving that position there, reducing that, is we've seen such a lot of currency volatility that, in particular, international treasury bonds look, certainly from a risk-reward point of view, perhaps less attractive than something like a shorter-term US treasury. But as I said, these are not large changes in the portfolio. The turnover was not huge. And this is part of our regular process in keeping everybody's portfolio up to date and reflecting the current market conditions. Moving on to the third of the functional portfolios, the inflation hedge portfolio. So again, just to remind people, the goal of this portfolio is to protect the real value of the assets in the portfolio. And so this portfolio invests into a range of real assets, and that includes things like property via REIT ETFs, as well as physical commodities, things like agricultural commodities, industrial metals, precious metals like gold and silver, oil, and also bonds which move with inflation, inflation-linked bonds as well. This portfolio was down 5.36% during the month. If we look at the assets in the portfolio, we can see the biggest single position is US real estate, followed by TIPS. These are the inflation-linked bonds, and then things like gold, base metals, and infrastructure. As we said earlier, pretty much every real asset, every commodity was down on the month of June. For us, the biggest detractors were this position in US real estate, and then also base metals as well. I think that makes sense given the concerns of a potential economic slowdown in the US. Other real assets, things like gold, infrastructure, and oil, were slightly negative for the portfolio. But as you can see, it's well diversified across a range of different real assets. So those are the three functional portfolios. We also have an additional global ESG portfolio. And here, the goal is to achieve a high return in the long term with a similar level of growth to global equity, but with an exposure to ESG. So an exposure to companies that promote environmental, social governance, corporate governance principles. This portfolio was down 7.76% on the month. In terms of its exposures, it invests into a range of equity-based ESG ETFs. So you can see they're diversified around the globe. So the biggest position we have is this 27% in EFA, so Europe, Africa, and the Far East. Then we have US large cap value, general US MSCI part, and then emerging market and US growth. But all of these ETFs are tilted towards ESG exposure. During June, the biggest drivers of the downward performance in particular were the largest position, the EFA position up here, and then also a US large cap value. So, as I said, it was a tough month for pretty much all assets. I think pretty much every investor out there has had a tough month during June. But that gives you hopefully a flavor of what was driving our performance. So I'll stop here for now. I'm happy to take any questions or any things that are unclear from anybody.
Thanks, Matt. If let's say you have any question, please key in your question in the Q&A from the Q&A button. So maybe I can just kick the ball rolling. Matt, I noticed from your performance table slide, sorry. So if you look at so commodity prices have hit a multi-year peak, right, in early June. And what we have noticed this year is that inflation rate has been rising, basically until the latest figure for US inflation is at a peak, for multi-year peak at 8.6% in May. So how's the trajectory of the inflation looks like in the next 12 to 18 months?
Sure. Thank you. I mean, this is obviously the underlying driver of a lot of this volatility across almost all of the markets. Has been this surge in inflation, particularly in the US, but also other markets as well. As you said, headline inflation in the US hit 8.6%. That's the highest level, I think, since 1981. So we're talking about a 40-year high. Inflation. And this is driven by a range of different things: spike in energy prices, various supply chain issues relating to COVID-related disruption, but also on top of that, a very strong US job market to wage growth and that kind of thing. So a range of different factors have been driving this inflation. Where we go from here, I think there's a couple of things we can say. If you look beyond kind of the headline inflation, what's called core inflation, and so this is a measure of inflation that excludes some of the most volatile parts of the inflation measure, things like food and in particular energy. So US core inflation was 6%, most recent number. And that's actually slightly down from the previous month. I think it was 6.2 perhaps the previous month. And so there are commentators who are saying that this is a sign perhaps that the underlying portion of US inflation perhaps has hit its peak and may be fading away. And I think there's good arguments to support that, I think. Obviously, anything to do with kind of supply chain issues, COVID-related disruption, you've got to expect those kind of impacts to be temporary.
Yeah,
you can't have a supply chain issue that lasts for multiple years. That doesn't happen. And so it's perfectly natural that part of these things will be temporary. And as that works through the system, you'll see a spike in prices, but then the rate of growth of prices should fade once that has been processed through the kind of economic system. So I think there's a good reason to expect that. And then also, the element of inflation that's come from energy prices. We've seen, we can see on the slide here that, natural gas was down, oil prices were down in June. They remain volatile, but perhaps they've reached a peak, at least in the near term. And, inflation measures like price change over the last 1 year. And so as those increases in energy prices gradually move through that 1 year window, eventually they'll fall out and inflation will naturally fall as a result of that. So I think the short answer is I think there is a good case to say that inflation, certainly in the US, may well have peaked, but I wouldn't expect it to fall very fast. These things take time to kind of work their way through the system. People start, there's an element of kind of self-reinforcement. People expect prices to rise, and so prices do rise, that kind of thing. And then underneath it all, there's still this very strong US job market. And if it continues as strong as it is, then that will remain a kind of underlying push of US inflation.
Sure. So yeah, so I think there's a lot of concern on definitely inflation, which I think to most people on the street is it erode the value of money. But at the same time, it has also caused a lot of worries amongst investors who invest in asset market. So there's this question from our audience, from the trajectory of the current market or economy, are we looking on a coming global recession?
So certainly, if you think of the global economy, I don't know of any economist, any serious economist who's predicting a global recession, so global economic growth to go negative. Nobody's expecting that.
Yep.
If you look at particular economies, then that is possible. And obviously the one that's getting the most commentary right now is the US. And so US Q1 economic growth was negative. Normally a recession is defined as two successive quarters of negative economic growth. So Q1 was negative. And so if Q2 is negative, then technically we will be in a US recession. We don't know yet. Obviously, we still haven't got the final numbers for Q2. I think most people are expecting Q2 in the US to be slightly positive GDP growth. But it's certainly possible that we could have a technical recession, a small negative growth in Q2 in the US. Other countries perhaps are unlikely to slip into recession, but that's where we stand in the US, I think.
So obviously recession risk is rising, but could be most I think significant in the case of US. And obviously when you mentioned that the US could perhaps be in a technical recession if the GDP for Q2 turn out to be slightly negative, right? So let's say if indeed US were to fall into technical recession or even a recession, right? What are some of the lessons that investor can learn from the past recession?
Yeah, sure. I think it's a couple of things to point. Maybe if we look at the different asset classes one by one. First off, the first point to make, especially if you're talking about equities, is a lot of a potential recession is already priced in. And so, there's been quite a lot of commentary recently about how equities tend to perform during a recession. And if you look at historical recessions, on average, the US market falls maybe just under 30% during a recession. Obviously, there's a lot of variation. The equity market and the underlying economy are not perfectly in sync. So, there are times when it falls by more or by less, but on average, during a US recession, the market falls around 30%. And if you look at, say, the S&P today, it's around just over 20% down from its peak. So you could argue, well, 20% out of 30%, well, 2/3 of a recession is already priced in. It's one way of looking at it. And I think that's a reasonable kind of way of thinking about it. You know, we're not 100% sure we're going to have a recession, but we've already priced in 2/3 of it. So it's not like any recession in the US would be a complete shock to anybody.
Yeah. Sure. So yeah. So maybe if you can share what are some of the lessons for investors, you know, when it comes to what we can learn from the past recession.
Sure. Yeah. I mean, maybe the biggest thing to learn from a recession is you know, to keep diversified during a recession. Recessions are bad for certain assets, things like equities, higher risk assets, but they can be positive for other assets as well. And there are certainly quite a few investors out there who are starting to think about bonds in general, perhaps more government bonds rather than high-risk corporate bonds. But you know, yields in the US and in other markets have risen to a level where, you know, they're relatively attractive. If we don't have a recession, then you're sitting on a reasonable yield already. And if we do have a recession, then at some point the Fed is likely to start lowering rates to try and stimulate the economy, which is positive for bond prices. So while it's very difficult to time that kind of thing, I think it's important to notice that, you know, a recession is not negative for all asset classes. And things like elements of fixed income, perhaps higher yielding dividend stocks, those kind of things can be really quite attractive during a recession.
Yeah. So it's important to stay diversified if, let's say, we were to go into a recession. So with the kind of volatility that we have seen last month, right? So how should investor navigate this kind of market uncertainties? You know, this elevated level of market uncertainties.
Yeah. So in these kind of environments, it's always tempting, I think, to try to time the market, to shift your portfolio around, to try and position yourself correctly. And I can understand that kind of view, given like relatively large movements month by month. I think, in my experience at least, predicting these kind of things is extremely difficult. Timing markets is extremely difficult. The best thing I think an investor can do is to keep their portfolio diversified, keep it up to date, keep it rebalanced. And also, if you have the ability to, keep adding to your portfolio. Of course, you know, seeing a number like this, you know, your growth portfolio down 7% in June, down 14, nearly 15% year to date, is unpleasant. However, equities will return. Equity prices will return. Nobody knows exactly when, but they will return. And so one way of thinking about it is right now, you can buy equities at a nice low price. And if you do have any spare money, gradually, perhaps month by month, regularly adding to your portfolio. A lot of people call it dollar cost averaging, but it's really just adding to your portfolio on a regular basis is a very good way of automatically taking advantage of market dips, things like that.
Yeah. Yeah. So it does make sense to buy low, you know, when equity prices have corrected so much. And on the other side, with bond yield becoming more attractive, it's also you know, good to have exposure into a more higher yielding bond that we've seen today. And I noticed the growth portfolio, the Chinese equity has been the best performing equity last month. And if you can share what are the current opportunities that basically we saw in Chinese equities.
Yes. So naturally, we focused a little bit on the US, given it's the largest position in the portfolio. But as you say, we have China as part of our investment portfolio. It's part of our investment universe. And so currently we have a 3% exposure in, these are China large cap stocks. So this is the FXI ETF, which you can see down here, iShares China large cap. So we have 3% exposure here. And then more broadly, we have a 5% exposure in NSCI Hong Kong. And from an investor point of view, these are attractive, perhaps for a couple of reasons. One is from a diversification point of view. Obviously, China is at a very different point in the economic growth cycle compared certainly to the US. Most people are expecting Chinese economic growth to accelerate. If you look at things like PMI indices, economic sentiment indices in China, they're starting to tick up. Potential loosening of COVID restrictions, and also just in general, a more supportive stance from the Chinese government in terms of economic stimulus. So these are all pointing to the Chinese economy being at a very different stage in the cycle compared to US and Europe, and hence it's a very good diversifying element to the portfolio.
Sure. Thanks. If there's any question from the audience, if we can take any question. So I think there's one question related to product, which is if we have any plan to introduce Sharia compliance portfolio. So I believe we are coming up with Sharia compliance portfolio very soon. So do watch the space as we work on the final details. If there's no question, perhaps I can share the key takeaway for this session tonight. Thanks. So we have noticed that almost all asset market has fallen in June, right? So mostly on the concern of the US economy and the aggressive rate hike by Federal Reserve. And Matt also shared that he believes there are signs that US inflation has peaked, but is unlikely to fall sharply thereafter. And the good thing is that the US labor market remains strong, and therefore it could actually translate to not a very heavy landing, in terms of the economic growth. So US equity has fallen more than 20%, slightly more than 20% from the peak. So basically, very much now depend on the Fed ability to engineer a soft landing so that the market can actually sort of have that comfort in investing again in the equity market. And the economic cycle in China is positive with government support, cheap valuation, and improving sentiment on the back of the relax in the restriction of the COVID-19 procedures. So for bond yield getting more attractive, especially on the investment grade universe, as well as the income from high dividend stock are looking more attractive than ever. Okay. So for investor, how to navigate the uncertainties? We believe that trying to time the market is extremely difficult and very difficult to do it consistently over time. Therefore, asset allocation, diversification, and dollar cost averaging will help to reduce risk associated with this short-term volatility, and also potentially earn more consistent return over time. So at MYTHEO, we remain consistent, we remain confident and convinced that our most effective investment method is to invest with a long-term perspective through a diversified MYTHEO Omakase portfolio of growth, income, and inflation hedge functional portfolio. So so that concludes the session that we have tonight. Thank you very much, everyone, for your participation, and thanks, Matt, for sharing with us the performance for last month. So we hope to see all of you again in our next webinar happening 2 weeks from now. Thank you. Good night.
Let's take a moment to talk about money. We all know how important it is to save. But no matter how hard we work to build our nest egg, experts believe most of us still won't have enough to retire comfortably. Investing is the better way to grow your wealth, but requires years to master on your own, or high fees and starting capital to hire a wealth manager. Now, there's an easier way for you to invest. MYTHEO is a digital investment manager that does the work for you using investment strategies with a proven track record, helping over 60,000 Japanese investors grow their wealth. That's over $300 million of assets under management. And this is all it takes to start investing meaningfully. When you create an account, MYTHEO will want to know you a little better. Things like your age, assets, and appetite for risk. Once it has collected enough information, a professional investment portfolio will be generated just for you. This portfolio will consist of ETFs listed in the US stock market. Each ETF is selected for its different feature, such as country or asset class, to further diversify your portfolio, and that disperses some of the risk. This global diversification strategy is one way MYTHEO optimizes your portfolio. The algorithm that drives MYTHEO's logical investment reasoning is based on the research behind 2 Nobel Prizes. In the past, you or your fund manager would have to closely monitor the market's various moving parts every day. That's a lot of data and decision making. With MYTHEO, you don't have to sweat the hard stuff. It automatically rebalances your portfolio to its prime investment position. What MYTHEO does for your portfolio is no secret. View the rebalancing data anytime from your account, accessible via the app or website. You might even want to start calling the shots one day. Go ahead and adjust the portfolio to suit your needs. After all the money talk, here comes the money talk. Thankfully, MYTHEO's service will not break the bank, just a small fraction of your investment. With no sales fee, no exchange commission, and not a single surprise charge. So the question to ask yourself is this: will it be worth it? Deciding to invest may mean new commitments and lifestyle adjustments. It could also mean the freedom to do what you've always wanted, not just life's milestones like marriage, kids, and retirement, but the moments in between that make life richer. Whatever it looks like, it's time to invest in experiences that truly matter to you, because life's moments are priceless.